are in listen-only mode.
Thank you for joining us today for this interesting webinar, Understanding the New MAP 21 Broker Bond Requirements, effective October 1st, compliments of Cline Wood University. Before we begin, a little bit about the technology. Your lines are muted for the duration of the webinar, but you can ask questions at any time by entering the information into your question box. We'll try to get to as many questions as possible given the time allotted for today's webinar. Now, allow me to introduce our speakers. Michael Yeniff, Senior Legal Counsel, AVP. He has a BA from Briarlift College, Juris Doctorate, Law degree. Mike joined Great West in 1996 as a liability attorney. He was promoted to Manager of Legal Subrogation Department, subsequently moving to Regulatory Operations and Compliance. Mike's past legal experience is extensive and includes the firms of Yeniff and Cosgrove and Bickel and Brewer. He's on the Board of Directors for Nebraska's Workers' Compensation Equity and a member of the AT Insurance Task Force. Now, please allow me to introduce our second speaker today, Sam Pershaw. Sam, Old Republic Surety Company, Vice President of Commercial Surety. He is currently the VP of Commercial Surety, 39 years in the industry, graduate of the University of South Dakota in '73 with a BS in Business Admin. He holds the CPCU and AFSB industry designations. And with that, let's hear from our first speaker. Mike, the floor is yours.
All right, thank you. Good morning and afternoon to all of you. Okay, we'll get right into it. So why don't we change slides? Okay. MAP 21, as it states, it was signed into law on July 6th of 2012. Now, what it mainly addressed was infrastructure spending. If anyone read this, first of all, you need a new life because it's a horrible piece of law. 600 pages, it's basically a jigsaw puzzle, and it was ugly to read and try to understand. In the middle of it, towards the end, was a small section regarding brokerage operations. And I have to believe that it was one of those things that was just thrown in at the time. And therefore, the FMCSA did not pay a lot of attention to it initially. And when questions were asked by us to them and by others to them, there weren't a lot of answers being provided, and really not that many at this point in time. So it was very difficult to get guidance as to how this 600-page document that had maybe 30 affecting brokerage operations was going to affect us both on the insurance side, trucking side, and surety side. Why don't you go ahead and switch? The two main brokerage issues that were addressed in MAP 21 are the registration of a brokerage operation and the increase in the minimum financial requirements. Now, a third item that you all must be aware of, and the other two items, registration, minimum financial requirements, I'm going to talk about those in a little bit more detail shortly. But another item that everyone needs to be aware of, and that's the last item that we're going to discuss, are the penalties for noncompliance. They can be ugly, but we'll talk about that in a little bit. Go ahead and switch. Okay. Beginning October 1 of 2012, remember, it was signed into law on July 6 of 2012, but effective October 1 of 2012, all entities that conducted themselves as a broker were required to separately register their brokerage operation. What was going to be provided to the operation when they registered was a separate, distinct registration number. Now, how that came into play, the separate, distinct registration number, and we had some issues with, was those motor carriers that also brokered that were using the same exact name. It was the same legal entity, both acting as a motor carrier and acting as a brokerage operation. When they were going in and trying to register at that time, as of October 1, there were problems with that, because in the past, when this registration took place using the same motor carrier name and brokerage name, same name for the brokerage operation, they were provided the same registration number. But as of October 1, there was supposed to be a separate, distinct number provided. We found out that the FMCSA, as the rest of us, were not prepared to handle this law that was passed. And so we were getting calls here at Great West from insureds, in which we issued a broker bond to, that were saying, hey, they cannot give us a separate number. Their IT systems were not updated. Honestly, folks, I don't know if they're still not able to provide a number. But what we advised our insureds, and I don't know what others are doing, but it was simply comply with the law. Comply with the law by registering. Whatever number the FMCSA provided, that's the number that they're providing you. And again, the reason why you want to make sure that you register are the penalties, which we will discuss later. Go ahead and switch. The second piece, which takes effect October 1 of 2013, is the increased minimum financial requirements. The law said that this was supposed to take place 1 year after the enactment of MAP 21, which would have been July 6 of 2013. For the longest time, we were trying, and then there were rumors floating around that the FMCSA said it was not going to take effect until 10/1 of 2013. Finally, the FMCSA themselves came back and said October 1, 2013 is the effective date. So that's the date in which everyone needs to increase their minimum financial requirements from $10,000 to $75,000. It's my understanding that there is going to be no exception at all made with regard to that. If you intend on complying with the law, it's a suggestion, and only suggestion, that you begin work. If you have not started working on getting the increase from 10 to 75, that you start. There are certain requirements. Great West, we handle bonds one way, or surety, which Sam will discuss, they handle their bonds in a different way. There are going to be certain requirements that must be met. In Great West, we have a specific timeline set forth to make sure that everyone complies. So if you have not looked into it yet, check into it and start working on it. Go ahead and switch. The penalties. Here's where they're going to get you if you do not comply. Again, you have to comply with the registration. You have to comply with the minimum financial requirements. If you do not comply, the penalty is a $10,000 penalty payable to the U.S. government for each violation. Each violation. So what does that mean? If you have not registered, let's say that's the piece that you have not met, and you have not separately registered your brokerage operation, and you broker 3 loads in 1 day, and the government finds out, you're going to pay $30,000 in fines for that day. So it's each violation. Also, and this is the piece that people are overlooking, is that you are going to be liable to the injured party for all valid claims regardless of the amount. That may be the one that really comes back and is going to be most punitive, possibly. Because, again, remember, when you have the bond for $10,000, it capped your exposure at 10. But if you don't have the bond and you get claims accumulating $500,000, we've had one actually close to $1 million in claims in the past, you're going to be responsible for paying those claims. So that's where it's really come back and bite you. And who is going to be responsible for this penalty? Well, I'm going to quote the law itself. It says, any person who knowingly authorizes, consents to, or permits, directly or indirectly, either alone or in conjunction with any other person, a violation of law is liable. So who does that include? That includes, obviously, the broker. That could include the agent, your insurance agent. That could include the surety. If any of those three parties are aware that you have not met the requirements set forth in MAP 21 for a brokerage operation. So all three of those parties could be responsible for paying the penalties. I think that's about it for my part. Yep.
Thank you. Our next speaker, Sam Pershaw. Sam, the floor is yours.
Well, thanks, Alan. I appreciate the opportunity to talk with everybody about this broker bond requirement. There's been a lot of activity on it recently, and it's only going to get worse as we approach October 1st. As noted, I'm with Old Republic Surety. We're a sister company to Great West Casualty Company, where Mike is from. And while Great West specializes in truck insurance, we write only surety bonds. Truck-related bonds such as this ICC broker bonds are included in that mix. So as most everyone knows by now, one of the requirements that the FMCSA puts on the brokerage operations is to put up security to protect the haulers of brokered loads from non-payment. And this can be accomplished two ways. And I think most everyone knows this, but in case you don't, it's important to know. Well, one is to put up a trust account, and the other is to put up a surety bond. So obviously I'd like to speak a little bit about the surety bond and how it's done, what's required from the broker and the underwriting process, and that sort of thing. So as Mike mentioned, the bond's at $10,000 right now, and it's been at this level for many, many years. They've been trying to increase it for quite some time, and we even had an inclination at one point that it might be much higher than 75, but they settled on 75. So at this point, that date appears to be an absolute, but I don't know. When it comes to the government, I guess you never know. If you want to switch the slide. The $75,000 surety bond for brokers really supplies two things, and I think this is similar to any kind of a surety bond. The number one is a form of pre-qualification for those that hold the brokerage licenses. And the second one, and the one that everybody pays most attention to, is it's a method of compensation for truckers who haul brokered loads, and then the brokerage goes out of business for some reason and they fail to pay for the service provided. So the pre-qualification part of it's basically a screening tool. By having the bond in place, it supplies some comfort to outsiders, to third parties, that this client or this broker has been screened in an underwriting process and at least passes muster on general quality. Flip the slide if you would. I think it's important to also understand one aspect of what a bond is. Since bonds are purchased generally through insurance agents, people tend to think of them as an insurance policy, but they are not. They're not an insurance policy. In other words, the bond doesn't just pay if the broker doesn't, and that's it. And it is not an instrument to protect the broker. Instead, the bond protects the truckers who are hired by the broker. These are third-party people, so it's a third-party guarantee that's given by the surety to protect those who utilize the broker's services and for some reason are damaged. So the surety only pays if the broker can't or won't. Sometimes it's or won't. And differing from an insurance policy or insurance product, if the surety pays out on a bond, they have rights of indemnity to go back to the broker and get paid back. And that's contrary to what you'd see with an insurance policy, such as a homeowner's policy or something like that. This indemnity issue is a surprise to some of our principals when we have a claim. So be aware of that. On the next slide, I'll give you a little bit of information about the underwriting process and what is required. I can't speak to every surety company because they all differ in what's required. So speaking somewhat generically, this bond is a financial guarantee. In other words, we're guaranteeing that our client will pay their bills. So consequently, underwriting typically centers around a review of the broker's financial condition and their credit history. So typically requirements include reviewing the latest year-end financial statements for the brokerage, reviewing financial statements of any holding companies if applicable, and perhaps other related companies. And also, oftentimes for smaller or closely held companies, the sureties will want to look at personal financial information for the owners. And lastly, and a big part of the underwriting for most every surety is a credit history review for both the owners of the business and the broker itself. There is, in this line, a direct correlation between a business's and owner's credit history and what can be expected in the underwriting of a financial guarantee bond like this. So now sureties differ. Everyone's a little different, but most sureties that write bonds like this require some aspect of this underwriting information. So as Mike talked earlier about getting at it and starting the process, that's what you're probably going to be asked to do, is to gather information like that to send it to the surety. On a related note to gathering this information, another variable is the quality of the financial statements that are reviewed. So more credence is given, for example, to a CPA audit or a review as opposed to compiled statements or internal statements. Old Republic surety, for example, does require a financial statement review, typically business and personal, unless the business is very strong. And we do run credit histories on everybody. Now, some of you may ask, how strong does the financial statement have to be to qualify for one of these bonds? And I wish I could answer that. Unfortunately, there's no easy answer, since every surety differs. But I think it's not a matter of net worth and working capital, simple as that. But I think it's safe to say that most sureties will focus on debt levels and equity more than anything else. And because in the past this brokered bond has been somewhat of an undesirable product, the underwriting goes way beyond what you might expect for such a small obligation. I mean, it's only $75,000, but it's underwritten as if it was bigger. If you want to flip the slide there, Alan. Our main concerns, might be interested to know what trips our trigger, what we're most concerned about. And obviously, first and foremost is the payment of losses, whether that's caused by a broker going out of business or a failure to pay for some other reason. We just don't want to pay claims, and that's safe to say. The underwriting process on bonds is done with an expectation that there won't be claims. It's not like insurance products where they know that there'll be a storm or there'll be a fire on occasion and they're going to pay a certain level of claims. Sureties look at these things individually and wouldn't write the bond if they expected a claim. Unfortunately, we don't have a crystal ball, and we're not right on that decision as often as you'd expect. But another thing to emphasize here, too, is secondary to the payment of claims. Sureties don't want claim activity, and I underline the word activity. With this bond, historically, there's been a lot more claims filed than ever get paid. And while that may not sound like a big deal, it really is. It's expensive to handle, to open a claim file, contact claimants and principals, help settle arguments, write letters, all that sort of thing. The file may be eventually closed without payment, but the overhead costs are high, and they really add up. So this is one of the main reasons why many sureties don't even offer this bond. As a silly little example, but it happens. You take a trucker who's sitting in a rest stop somewhere and needs payment for hauling a load wired to him so he can fill his gas tanks to head back home. There's a delay for some reason. So what does he do? He calls the surety company. So then we have to make phone calls and do a bunch of work to try to get the little dispute or whatever it is settled. So I'll give you an example of how cumbersome this can be. There was a point in the last 5 years where our company, on an annual basis, was getting 60 claims for every 100 bonds we wrote. And that's just unmanageable. Now, very few of those actually paid. But we tend to look at the part of the underwriting process. We look at their systems and bookkeeping and procedures in place to help prevent what we call these sloppy claim activities. So it's cumbersome for everybody in the surety industry who writes these. Next slide. I want to talk just briefly about collateral. Sometimes sureties will write this broker bond with collateral. We tend to do both at Old Republic. We write some without and some with. But the type of collateral varies, but typically the typical way is to get an irrevocable letter of credit from the applicant's bank in the amount of the bond. Some sureties take cash, but that's rare. The reason for the collateral is obviously to protect us, protect the surety from any true monetary exposure, and it places the actual exposure on the bank issuing the letter of credit. But it occasionally makes sense for the broker to do this, as they might have easy access to bank credit, for example. In these cases where we take a letter of credit, and most sureties have their own form, and most sureties have to pre-approve the bank prior to taking the letter. Now, for those of you who are interested in doing it, approaching it that way, and some of you may already have a bond with collateral, there are a few downsides to be aware of. One is the duplication of cost. And a fee has to be paid for the letter of credit to the bank. And also there's a bond premium to be paid. So you double up on your expenses. Another downside is that in the event of a bond cancellation, the surety would typically hold that letter of credit for a period of time after cancellation of the bond before returning it, in case claims come up later from the period of time the bond is in force. And lastly, securing a letter of credit from the bank may tie up some of your operations available credit with the bank that you could use for other things. So we need to be aware of those downsides. And one other thing about collateral to mention is that remember that once a surety company cancels one of these bonds for any reason, that does not relieve them from any liability which is already accrued under the bond for the period of time it was in force. So claims could conceivably come in months or even years after the bond cancellation date. I'm not aware of what the statute of limitations is, but it can be quite lengthy. So if you do secure a bond with a letter with collateral, you need to remember that you may not get it back for quite some time. And if you switch sureties and go to another surety that also requires collateral, then you'll have to double the collateral out there for a period of time. So sureties differ as to when we return it. The common practice is to hold it 6 months to a year, thereabouts, to assuming no claim activity. Next slide, please, Alan. Okay, the existing bonds and how they're going to be changed. Mike referred to this as he's not sure that the FMCSA really knows how they're doing all this, and I have the same message. I don't know how they're going to change these bonds. Right now, when a bond is done, we have access to the FMCSA website. We go in, we put in the bond information for that particular broker, and the bond automatically exists at the amount of $10,000. At this point, we have no access to put in a $75,000 bond for a broker. So if we're doing a new one today, we're putting it in as 10. We're underwriting it as if it's 75, and we're getting ready for when it increases to 75. But it isn't 75 yet. And I don't expect this to change until I'm hoping to get at it quickly, but I think we won't see that until September maybe. Let's see here. Well, last slide. Just as a matter of summation, it's important for everybody to know that as you try to get these bonds out in the marketplace, they are considered in the surety industry a tough bond. Many sureties don't write them. Some write them very carefully. Old Republic surety got out of this line a while back, but we're getting back in with some different underwriting. And we think if the underwriting process is controlled up front, it can be done successfully. So we're looking forward to the opportunity, but it's going to be pretty hectic here for a while. That's it on my comments.
Well, thank you very much, both gentlemen. We really appreciate the information today. We are going to move into our Q&A session now. As a quick side note for those who might be new to this webinar series, this is the Cline University webinar series. They run monthly webinars on important business-related topics to the transportation industry, like today. Make sure you whitelist any emails coming in from them. And with that, we're going to move into our Q&A and launch a poll, letting people know if you'd like more information. Please let us know whether it's on this topic, another topic, or just a complimentary review of your current coverages. Now, with that, we have time for a few questions, and I'm not sure who will answer these, so I'll ask the speakers to decide who should answer it. The first one, are haulers of purely exempt commodities required to register as a broker, required to register under MAP 21?
I'll handle this. This is Mike. That question has been asked quite a bit lately. And unfortunately, as I said before, the FMCSA is not helping us give an answer. What I can tell you is that if you have a question on that, what I would suggest is that you contact the regional office of the FMCSA in which you do business. So let's say if you're in Iowa, I would contact them and ask them whether or not you need to register as a broker if you're hauling purely exempt commodities. And why I say ask that state, because I've talked to 2 different states on this issue and received 2 different answers. So that's the best answer I can give on that at this point in time.
Thank you very much. The next question that came in, I'll try to read this correctly, is the effective date of October 2013 a firm date, or perhaps it's not so firm as you mentioned in the webinar?
Again, I'll handle this one. I've been asked that question by a number of agents. They're hearing rumors that it is going to get pushed back. We've heard nothing official on that. So I would recommend that you work as if October 1 is a drop-dead date. As Sam indicated, though, with the government, you never know what's going to happen. But I would not rely upon the fact that I would not rely upon a rumor. Go with 10-1.
Thank you. Another question, what are my options if I was turned down for a bond due to my financial situation?
I'll take that one, Mike. I guess all I can emphasize on that is to keep trying. Go to your insurance agent, and if they're an independent agent, they will have a number of markets. And if they have more than one market that writes this bond, they'll all have slightly different requirements. There's a home for virtually every one of these out there in the marketplace. And if a local agent can't get it done with normal markets, they go to what we call a brokered market, who has companies who take riskier business, and it might cost you more. You might have to put up more collateral or something, but it always surprises me in this industry that there's always a market for virtually every risk, regardless of what it looks like. So keep trying in that regard, and start with your insurance agent.
And this is somewhat related, and we have time for one more question. We're right about 30 minutes now for the webinar. Do you expect rates to change for the bond, and what can I expect generally for the cost of this bond to be?
Okay, I'll answer that one too. Rate per thousand, I don't think those are going to change. In fact, some of them might even go down because the bond is bigger and generates more premium by itself. But the total premium, or the total cost of the bond, is obviously going up, if nothing more, in proportion to the amount of the bond going from $10,000 to $75,000. Rates in the marketplace for this bond range from very reasonable to around 1%, all the way up. I've seen them as high as 10% rates with collateral in additions for more troubled risks. So the gamut, I mean, it covers the gamut. There's all kinds of rates.
Well, thank you very much. There are some additional questions, and you can reach out to university@clinewood.com or call them at 913-451-3900. Their website is www.clinewood.com, and they'll be happy to answer additional information. Feel free to reach out to them. For anyone who responded to the poll, you will be hearing from Cline Wood, and we thank you for your interest in additional information. Again, thanks to our speakers today, which was terrific, Michael Yenef and Sam Pershaw. Great job, terrific information, very educational. And we thank all of you for attending another Cline Wood University webinar. This web seminar is now ending. We hope you all have a great day.